Welcome to this explainer. Okay, if you've ever felt totally overwhelmed by all of the noise, the crazy charts, and the impossible jargon around money and investing, well, you are in the exact right place. We're going to break down J.L. Collins's incredible book, The Simple Path to Wealth. We'll translate his time-tested strategies right here onto these slides for you and completely strip away all that confusion. We're going to show you exactly how financial independence isn't just for the lucky few, it's a totally achievable reality.
Right. So what if the secret to wealth is actually just being incredibly boring? Seriously, we're constantly sold this idea that you've got to be some Wall Street wolf to build serious wealth, that you need to actively trade, perfectly time the market, pick the next huge tech stock, or have access to some insanely complex algorithm. But look, the sources reveal that this is just the great myth of investing. Success isn't about finding a complex new system at all. It's actually about the discipline to just remain boringly consistent.
Actually, just listen to Jack Bogle on this. He's the legendary founder of Vanguard, and talking about timing the market and picking winning stocks over the long haul, he said, "After nearly 50 years in this business, I do not know of anybody who has done it successfully and consistently." Think about that. The finance industry literally needs you to think investing is terribly complex so they can step in as the experts and charge you massive fees to manage your money. And those fees, they are an absolute drag on your wealth. The more complicated your investing is, generally, the less effective it actually becomes.
All right, let's dive into our incredibly simple roadmap for today's explainer. Number 1, the myth of complex investing. Number 2, 3 pillars of wealth. Number 3, the ultimate investing engine. Number 4, surviving market crashes. And finally, number 5, reaching financial independence.
Section 1. The myth of complex investing. Why Wall Street wants you confused.
Okay, get this. The financial industry is basically just a giant marketing machine. If they came right out and admitted, hey, all you really need to do is buy a simple, low-cost index fund and wait, they wouldn't be able to charge you 1 or 2% a year in management fees. So they create all these complicated derivatives and actively managed funds just to justify their existence. But let's look at how those quote-unquote experts actually perform. 82%. Over a 15-year period, a staggering 82% of actively managed funds actually underperform simple index funds. You're paying high fees to highly educated professionals, and over 8 out of 10 times, they do worse than a basic passive index fund that requires zero effort and charges practically nothing. Once you realize this intentional complexity is working against you, it's so freeing. You can just totally ignore the noise on the financial news channels.
Section 2, 3 pillars of wealth. The beautiful simplicity of J.L. Collins's framework.
So, if we're throwing out all those complex strategies, what do we replace them with? Well, it all comes down to the foundational habits required to start building real wealth. It's what Collins calls the algebra of wealth, and its simplicity is absolutely its superpower. Step 1, avoid debt. Avoid it like the plague. Debt is a vicious destroyer of your wealth-building potential. It just traps you. Step 2, spend less than you earn. And we aren't just talking about saving 5% here. The goal is aggressive saving, targeting up to a 50% savings rate by totally rejecting lifestyle inflation. And step 3, invest the surplus. Because saving alone won't get you there, inflation is just going to eat your cash. You must put that surplus to work so compound interest can do its magic.
Now you might be wondering, why go to all this effort? Well, it's definitely not to buy a bunch of status symbols. It isn't to finance some $32,000 car that loses half its value the second you drive it off the lot. It's to build what Collins famously calls FU money. This is a massive mindset shift. Wealth isn't about looking rich. Wealth is about buying absolute freedom and autonomy. It is the power to walk away from a toxic job, to take a year off to travel, or to just live life entirely on your own terms.
Section 3. The ultimate investing engine. Why broad market index funds win.
All right, we know the why and the basic steps. Let's get into the how. How exactly do we invest that surplus? We need a tool that's highly effective, incredibly low cost, and requires literally zero daily effort. Enter the ultimate investing engine, Vanguard's Total Stock Market Index Fund, or VTSAX. Now, what's really interesting here is this expense ratio, 0.05%. In plain English, that means they're only taking 5 cents for every $100 you invest. Your money actually stays in your pocket to compound. Second, you get massive diversification. By buying the single fund, boom, you instantly own a tiny piece of over 4,000 publicly traded U.S. companies. You're just betting on the long-term success of the entire U.S. economy. But the third point, this is the real secret sauce. It's this self-cleansing mechanism. When you pick individual stocks, you're constantly sweating, right? You're wondering, when do I sell? Because companies have life cycles. Think of a giant like Sears that ruled the world for decades, only to completely fade away as Amazon took over. If you were holding Sears stock, you lost big time. But a total market index fund is cap-weighted. That simply means the bigger and more successful a company gets, the bigger piece of your pie it naturally becomes. As Amazon explodes in growth, it automatically becomes a larger portion of the fund. And as a company like Sears fails, it shrinks and eventually just drops off the index entirely. The fund does all the hard work, all the cleaning, totally on autopilot for you. You never ever have to guess.
Section 4. Surviving market crashes. How to weather the inevitable storms.
Okay, it is super easy to hold an index fund when everything is just going straight up. But let's address the elephant in the room. The absolute biggest behavioral hurdle for any investor is that very natural urge to completely panic and sell everything when the market takes a dive. I mean, look at history. The Great Depression saw a 90% loss. Then Black Monday in '87, the tech bubble bursting in 2000, the massive 2008 financial crisis. Yet, despite all these massive historical catastrophes, the market has always recovered and continued its relentless upward trend. In fact, if you just invested steadily from 1975 to 2015, a period containing multiple devastating crashes, the market still returned an average of nearly 12% annually.
And that is exactly why Collins tells us to, quote, learn to love Mr. Bear. When you're in your wealth building phase, meaning you're still working and consistently throwing a portion of your income into the market every month, a market crash is honestly your best friend. Why? Because the market is basically throwing a massive clearance sale. Every single dollar you invest buys dramatically more shares of the index than it did the day before. You aren't losing money. You are aggressively accumulating wealth at a steep discount. You just gotta hold your nerve and stay the course.
Section 5. Reaching financial independence, the ultimate destination.
So you avoid debt, save aggressively, invest in VTSAX, and ignore the panic during crashes. Eventually, you're going to reach the finish line. But right as you hit your target, your strategy makes a subtle shift. See, during your wealth accumulation phase, when you have a job and a steady paycheck, you can absolutely afford to be highly aggressive, keeping 100% of your investments in stocks. But when you transition to the wealth preservation phase, meaning you actually step away from your job to live off your investments, you lose that salary cushion. That's when Collins suggests shifting to 80% stocks, 15 bonds like VBTLX, and 5% cash. The bonds act like a shock absorber. They smooth out the rocky ride of the stock market so you aren't forced to sell your stocks at a huge loss just to buy groceries during a downturn.
But how do you actually know when you've officially made it? You use the 4% rule. It's just beautifully simple math. Track your annual expenses. Let's say you need $40,000 a year to live happily. Multiply that by 25. That equals $1 million. Boom. When your portfolio hits that number, you are financially independent. Historically, if you withdraw just 4% of your portfolio each year, adjusting for inflation, your money should easily last for 30 years or more. And honestly, it'll probably continue to grow. It gives you a crystal clear, concrete target to aim for.
So I'll leave you with this. If you had FU money, what would you say no to in your life right now? Would it be a totally stressful commute, a demanding boss, or maybe a lifestyle you're only maintaining to keep up with the neighbors? Because ultimately, the simple path to wealth isn't really about money. It's about your life energy. By making just a few simple, disciplined choices, living below your means, avoiding debt, and letting a low-cost index fund do the heavy lifting over time, you can literally buy back your life. Thank you so much for joining me for this explainer. Keep saving, stay the course, and I'll catch you next time.